Hey YouTube universe, I have a great question from Johnathan Rasean. And it says, hey ET, what would be the smartest way to invest $1,000 a month for a year? Well, Jonathan, great question. However, it's going to require a long answer. So that's the purpose of this video, to answer that specific question. Check it out. All right, Jonathan. All right, here is a long answer to your great question. All right, so to start things off, you're talking about, okay, what would be the smartest way to invest $1,000 a month for a year? In order to answer this question, there's actually going to be some more questions I need to ask you. But before I get into this, let me give you the backstory of this Jonathan question. All right. Jonathan responded to one of my emails, and this was the question that he had. So I emailed him back. I responded back to his questions, pretty much saying, hey, great question. It's going to require a long answer. I'll make a video about it addressing that specific question, because I think that a lot of people would like to know whether it's $1,000 a month, $500 a month, or $100 a month. The answer pretty much is going to be the same. So here's the video. Now, I was going to do some research real quick, and so I went and I seen that Jonathan had a YouTube account. So I went to his YouTube account. Now, Jonathan's name on his reply back to me, his comment back to me, was Johnathan Rasean. All right. I went to the YouTube channel, and lo and behold, it's one of my cousins, my first cousin. All right. The son of my Aunt Dorset Dale, living in Aurora, Colorado. This was him, Johnathan Hawkins. So I looked at his video and it was very impressive. You know, he talked about how to be the best dad, his 5 tips. Matter of fact, great video. Want you guys to check it out. I'll put the link below of this video here. But regardless of whether it's my cousin or not, this is pretty much the response that I'm going to give. All right. So in a situation like that, how should you invest? What is the smartest way to invest your money? There's a checklist that you need to go through first. There's some questions that we need to ask you, that you need to be asking yourself. And here we go. First of all, let me just say this. I am not a financial advisor. And the very first thing I would do is tell you, speak to your financial advisor. Check with your financial advisor. All right, get his recommendation, get his or her advice, but also make sure that your financial advisor is a fiduciary. That basically means that he or she has your best interest in mind. All right, so check with your financial advisor. If you don't have a financial advisor, you might want to go out and look for one. Look for a fiduciary, and ask questions, find out what they're about. All right. So now that's number one. The next thing on my checklist that you need to really ask yourself and check off, and that is, do you have an emergency fund? An emergency fund is so important. Do you have 3 to 6 months of living expenses set aside in an account that's liquid that you can get to if an emergency happens? If that's no, guess what? That's what you need to focus on. You need to use your money to focus on building that. This is the reason why, because if you have an emergency fund, you are in a position of power. This is what I mean by that. If you don't have an emergency fund and you start investing, and all of a sudden you have an emergency, guess what's going to happen? you're going to have to tap into your investments in order to take care of that emergency. That's going to defeat the whole purpose. You may have to tap in at the wrong time. Maybe your investments, maybe the market is down. And because you have an emergency, guess what? Now you have to sell for a realized loss. That's what I mean by having an emergency fund, especially when you're investing, puts you in a position of power when it comes to investing. All right, so make sure that you have 3 to 6 months emergency fund set aside. All right, next thing you want to look at your consumer debt. If you have any consumer debt, I'm not talking about your mortgage, but everything else. If you're paying more than 5% interest, you need to take care of that. You need to get rid of that. You need to get that off the books. And the reason why is because you're paying more than 5%. That consumer debt is going to eat into your net worth. It's just not a smart move. So if you have consumer debt over 5%, use that money that you normally would invest in to get that off your plate. If it's credit cards, get it off the plates. Get it off your plate. All right? The key thing there is look at what is your interest rate. If it's 5%, if it's more than 5%, you need to get rid of it. You need to take it off your plate. All right, so let's just say you have no consumer debt, that you're paying over 5% interest. Good. So check mark. Next thing you want to take a look at is where you work. Do you have a 401k or 403b or some type of TSP? And does your employee match? If that's the case, you need to make sure that you're at a bare minimum, you're contributing up to the level of matching. And the reason why is because that's free money. If it's a 5% match, you contribute 5% of your income to that, and they're going to match it. Whatever it is, whatever the matching is, maybe 50%. Most common, that's what you're going to find, 50%. I've also seen some 100%. But contribute up to your up to the matching, percentage-wise. All right, so let's say you've done that. Bottom line, now take a look and see if you qualify for a Roth IRA. If you're married, and I know Johnathan, you are, if you guys are making less than $198,000 a year, you qualify for a Roth IRA. Take advantage of that. Roth IRA, if you're under 50, you can contribute up to $6,000 a year. The reason why you definitely want to focus on a Roth IRA is because your capital appreciation, your earnings that's in a Roth IRA will be able to grow, and you don't have to worry about ever paying taxes on it. Once again, if you got a good financial advisor that's a fiduciary, that person will let you know about that. All right. Also, now what you want to do is you want to take a look at your risk tolerance. Is it high, medium, or low? I can tell you right now, my risk tolerance is high. But everyone's going to be different. That's going to be a key component. Also, what I didn't put up here is you need to ask the question whether or not you are a passive or an active investor. I'm an active investor. But when I started out investing, I started out as an active investor, pretty much buying and playing the option games. Okay, it worked out initially, but in the end it didn't. And then I converted over to being a passive investor. All right, putting my money in my TSP, having traditional IRAs, Roth IRAs, and that type of stuff, going into the index funds and so forth, and letting the market do what it does. It did a good job for me. All right, so you need to figure out which one do you want to do. Do you want to be a passive or active investor? Active investor is going to require some of your time. Keep that in mind. So once you figure that out, let's just say you want to be, let's start with passive. If you're going to be a passive investor, then fine. This is what I would recommend to anybody that's a passive investor. You want to max out that Roth IRA. If you qualify for it, max it out. You're looking at, you're under 50 years old, that's $6,000 a year. What is that, $500 per month? You want to max that out. You want to max it out. Once you max out your IRA, okay, let's go back here. Max out your IRA. If you got an employee matching 401k, 403b, TSP, you definitely want to take care of that. You want to go up to the max. You want to go up to the matching portion of it. Then once you have that, you want to max out that Roth IRA. If you still have money left over and you met the employee matching and you maxed out the IRA, and then you want to circle back and start maxing out that 401k, 403b, TSP. And what you want to do, regardless of whether it's the Roth IRA or the 401k, if you're a passive investor, my recommendation to you is go with index funds. You want to get something to match the market. Don't worry about the market. Right now, the market is all-time high. All-time high. Don't worry about that. Don't let that scare you off. Because yes, there's probably going to be some type of consolidation or correction and possibly even a crash. Doesn't matter. Because what you want to do is you want to do dollar cost averaging. You want to take a certain amount of money and invest, whether it's in your 401k or a combination of your Roth IRA, invest a certain amount of money in those various types of index on a regular basis. So when times are good like now, fine, you won't get as many shares. But if it crash, correct, or go through a consolidation, guess what? You're getting more shares. It's all going to average out. And when I talk about indexes, you want to have an index that follows the market. You can go with the most, you can have one that tracks the Dow. You can have one that tracks the S&P 500. You can have one that tracks the whole market. That's in the US. If you want, you can also get into emerging markets, country that are up and coming in growth. You can invest in those type of countries. But bottom line is, invest in index funds. Make sure that you do the dollar cost averaging. That's if you're a passive investor. Now, if you're an active investor, if you want to be an active investor, it's going to require your time. And what I say is you want to find your sweet spot. Everyone is going to be different. I already know what my sweet spot is. Right now, my sweet spot that I'm looking for is I am trying to build up my dividend portfolio, because that's true passive income, but also concentrating on some growth stocks and some speculative stocks. Now, I'm looking at things like digital wallets. I'm looking at 5G, companies that are involved in 5G, EV, electric vehicles. I'm also looking at the MJ stocks as well. And also what's heavy on my radar also right now is space. All right. Whatever you find your sweet spot, find a few stocks, ETFs, or whatever you choose, and you want to start building your position. Now, I watch a YouTube channel by Chris Sane. And one of the things he constantly preach about that I agree with 100%, and I like his technique, is when you're building out your positions, build out your position with the goal of acquiring a minimum of 125 shares of that particular stock. So my suggestion is, if you're going to be passive, figure out at least 3 stocks that you would like to build a position in and start using that money to build those positions in. You know that you built it once you got to at least 125 shares. You can build your positions beyond that, but at bare minimum 125. All right. You want to start also looking and trying to project at least 5 years out. Don't let the price of a stock scare you off. I remember when Amazon was at 600 bucks. Look at it now, 3,000. At 600 bucks, I thought it was overvalued when I was doing fundamental analysis on it. All right. If I was smart, I would have been looking 5 years ahead. Is the current price now reflective of 5 years ahead? And at that point, it's not, because look, when it was about in the 600s, that was back in 2016. Now look, that was 4 years ago. It's over $3,000 now. A lot of people say it's still overvalued, but look at the price now and project where it's going to be in 5 years from now. Does Amazon have enough resources and forward vision that in the next 5 years that you wish you would have had a share of our shares of Amazon at $3,000? That's what I mean by look 5 years ahead. Okay, try to project that 5 years ahead when you're looking at especially growth and speculative companies. Get in the habit of studying the market. You need to know what's going on within the market. Because not only does the revenue or the growth potential of a stock affects the current price of a stock, but also the overall market affects the current price of a stock. The projections could be great. The 5-year look ahead could be great. The revenue growth could be great. But guess what? When the market takes a turn, most of the time, the vast majority of the stocks will take that turn with the market. All right? So start studying the market. Don't let the market panic you. If the market crashed, we're at an all-time high. A crash basically means that guess what? The market is going to correct 20% off its high. So if it crashed, don't panic. Don't sell. Because once you sell, you realize your loss. Hang on to your stock. Especially if it's good stock that you want to hang on to for a while. Because guess what? One thing that's true about the market will recover 100% from a crash. History shows that. All right. I also would say learn about options. Options are great ways to leverage your assets. All right? Learn about options. A lot of people know about buying options. I started off buying options, but right now I'm a seller of options. It's actually I'm generating a lot of income from that. All right. Practice trades. All right. As you start to learn about options versus just getting in and doing it, because realistically, that's how you're going to get good at options, is actually by participating. But before you put that money on the line, I would suggest to you set up an account. A lot of the brokerages will have ways that you can actually do a paper trade. Start paper trading that account using, that paper fake money, saying, hey, this is the technique or the strategy that I'm going to use, and get good at it. Understand it. Somebody said that you can't read or watch how to do a push-up correctly. You can learn about the techniques. You can read about the techniques. You can watch somebody do a perfectly technical push-up. But guess what? You got to get out. In order to perfect it, you got to actually get down there and do it. Paper trading allows you to do that before you actually commit your own money. I am a high proponent of paper trading before you actually start doing it. All right? Focus on building your net worth. All right? You're talking about capital appreciation at a young age, and I know with you, Johnathan, you're in your late 20s, mid 20s, or late 20s. Start focusing on looking at stocks that also pay dividends. it may not be important to you now. Now is the time to start accumulating those stocks. Dividends are true passive income plays, period. And also what a lot of people don't concentrate on is this right here. Figure out a way to generate income. The only way that I know how to generate income when it comes to dealing with stock and equities is through selling options, not buying them. Last year is when I first started on this journey of selling options for premiums. Last year, I generated $46,000 in true income. When I say income, I'm not talking about capital appreciation. I'm talking about income, money that actually hit the bank that I can do a few things with. I can withdraw it. And then once I withdraw it, I can spend it. I can pay bills with it. In my particular case, all I did was invest it. So I reinvested over $46,000 last year without my contribution. So I believe in that. That's a way that I honestly think that's one way that you can build your net worth. So what I would do, if I had $1,000 a month and I checked off all these areas there, I don't have a financial advisor because I can do it myself. But I would make sure I have an emergency fund. My consumer debt, I really don't have any. TSP matching, well, right now, guess what, guys? Hey, I'm fully retired, so I don't have that. Roth IRA, I contribute that every year. On the 1st of January this year, because I'm over 50 years old, I put $7,000 into my Roth IRA account. My tolerance, I have a high tolerance. That's just me. I'm an active investor. So what I would do, since I went through my checklist, me personally, I would build my positions. In other words, if I had $1,000 and I went through that checklist, I would start building my positions. My sweet spot that I like and that I think the future is, the 5-year outlook looks good with me. I like Tesla. I like Apple. I like anything dealing with space, and in my particular case, there's only one real play out there with space. There's others, but mine is Virgin Galactic. I also like the space play when it comes to ARK investing. Probably within the next couple of months, they're going to come out with a space exploration ETF. But also I like Berkshire Hathaway. That's what I would do. That's what I would start building my positions in. All right. So once again, Jonathan and anyone else in this same situation, regardless of the amount, if you're planning on investing on a regular basis, please go through this checklist. And if you decided that, hey, you went through the checklist, you want to be an active investor, then definitely do that. Look for your sweet spot. Find some stocks that you would like to invest in. Make sure that the 5-year outlook looks good. Start building your positions in. And once you start building those positions, also you want to start looking at increasing the number of dividend stocks that you have and start paper trading ways that you can learn to generate income. When you start talking about selling premiums, you're looking at selling cash secure puts, selling covered calls, or a combination of those through the wheel strategy. So the key thing there is paper trade those. Get an idea. Get your feet in the water. That's what paper trading does. And then, once you feel comfortable there, jump in. With that, I wish you nothing but luck. Jonathan, since you're my cousin, I haven't spoken to you in a while. If you have any questions, either you can hit me up on this channel or you got my number. Talk to your mama. She can give you my number if you forgot it or lost it. All right. You guys take care.